about everything we talked about, the ATRs, fixed range, everything. I'm going to talk about not only what are the ways you can stop loss, what are the problems with it, what are the advantages, pros and cons, everything. And then I'm going to give you some of the best way to use the stop losses as well. Okay, so today's topic, perfect your stop loss. The reason is, if you perfect your stop loss, it is the best way to protect your capital and also your trade. There are a lot of times, if you, every trader would have came across this. You had your trade, you have your perfect entry, you had your stop, the price goes to your stop, take you out, and then reverses, goes to your target where it was before. How many times you felt like frustrated because the price came back down, took you out of the trade, and then moves back into your where the place the target was? This is something we have seen time and time again, right? Those reasons is that what it says is that your trade setup was correct, your theory was correct, everything is correct. One difference is, on that instance, you just made a mistake of placing the stop loss at a wrong place. That's the only difference. So that's what we are trying to fix it today. Okay, that's what our goal. My goal is to help you understand why it happens, how it happens, and then what are the ways you can protect it. At the same time, nothing is 100%. My goal is to minimize your errors, minimize your some of the very common mistakes by showing you how it happens. Okay, so before I get started, please understand this presentation is meant for educational purpose only. I'm not here to sell any securities, any kind of money making machines, anything like that. To show you what we have, our team learned based on years of trading, how we use it effectively, purely educational purposes. If you want to know more about the risks involved in day trading, in trading in general, please visit buysideglobal.com/disclaimer. Okay, so this is a typical chart in NinjaTrader. Every time there is a trade, there's a lot of traders. Every trader should have a stop loss. I'll start with that very most important factor. I know some of the traders who don't use stop loss. Please don't do that. I think first you need to understand why you should always use stop loss. Once you enter your trade, that could be million things could go wrong. Your internet could go down, or your machine could slash, power could go off. Anytime anything could go on, stop loss is the only one is going to protect you. Even even people who don't want to have a stop loss, put somewhere, at least minimize the maximum limit. But we're not going to talk about that. We're going to talk about how to perfect it. But please do not trade without any stop loss. That's a first and important message that I want to start with today. Okay, so when it comes to stops, different traders have different stop for different contracts, or one stop for every contract. It doesn't matter, but stops, make sure you keep it there. Let's start with, before we let me before I'm going to show you what are the best ways to use stop loss. I think the best way, I was thinking about how to start. Should I start teaching how to use a better stop loss, or I want to step back and see what are the most common mistakes first? Because unless you know what's the common mistakes you can making and why behind it, you'll be able to understand the solution that we're going to propose in a few minutes. Okay, so to start with, how many people said fixed stop loss? How many people said fixed stop loss? When you say fixed stop loss, what it means is that you enter your trade and then you fix, like, I'm gonna take only like 10 ticks, or like if you have 20 ticks, doesn't matter. You um, fix your stop loss based on the ticks from your trade entry. So what is the problem with that? The problem is, when they pick the fixed stop loss, the reason is they pick the stop loss based on the pain threshold. Every trader have different pain threshold. Let's say somebody starting up, they don't have enough money in the account or something. They are starting with a very small account, very tiny account. What do you think the stop loss will be? Uh, um, Maybe $100 or $50 for a years, or like a few. So they are picking the stop loss, picking the ticks, picking the how many ticks they wanted to have the stop loss based on the pain, how much they are ready to lose, their pain threshold. The problem with that is that market doesn't give a shit about your pain level or my pain level, or like how much you are okay to lose. Market doesn't really care. So market is going to do what market is going to do. So that means if you are taking fixed stop loss, irrespective of the market structure, irrespective of the market behavior, most likely you are going to get stopped out, because you are going to calculate your stop loss based on where you enter the trade, and then you're going to, based on your pain, how much you can lose, you can put that. That's the biggest mistake you can ever make. Okay. And then other ways is that, so if you look at some people say, okay, you know what, but fixed, but I'm not going to be based on my pain threshold, I'm going to look at the ATR. Even if you go and look at the YouTube search for best stop loss suggestions or strategies, all the internet gurus talks about ATR, 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 ATR. Let me tell you, it's nothing worse than the ATR. Let me give you some examples as well. Okay, let me try to explain you, because I know a lot of you have very great trust in the ATR. In order to instead of just telling you ATR is not reliable, I wanted to show you why. Okay, so let's say the price moves like this. Can everyone see my screen? Let's say the price moves like this, and then you can see the market is range bounded, and then you want to take let's say you want to take a short trade, right? So in that case, you want to take a short trade right here. If this is the entry, you are thinking, where can I keep my stop right now? You look at the ATRs. ATR says like you can take in like 12 or 13 ticks based on the true average range of the bar so far. The way it calculates, it looks at how many, what is the average size of the bar um, for the past 14 or past 21, doesn't matter what our settings are, it's going to give you the average. It takes the minimum, low, and then like calculate the average and give you some number. So in that case, if this is your entry, let's say this is what your stop loss is based on your ATR, it's a fixed number. So what it is, this is the fixed range of your risk. Okay, so the problem with that, if your entry is here, then stop goes here. If entry is here, the stop goes somewhere here, right? So if at the same time, if your entry is what? If entry is somewhere here, it's your stop goes where? It's like fixed. It doesn't really have any kind of understanding of the market structure. It's fixed based on how the market moves in terms of out to range. Okay, so that's why it really doesn't matter. So in that case, if you think about, like, let's say if you take the let me remove this one, let me put back. So let's say if you take the entry here, and then if you have your stop loss here, I wanted to think about how the market works. Market is always like if you come back, I'm going to talk about a little bit in market section a little bit later, but for now it can take out and come back down, because this is where all the full support zone right there. So ATR is same as your fixed stop loss. I'll put both in same bucket. I'll put the same thing, same bucket. Okay, so in that case, let's look at next important topic. How many of you know what is market structure mean? What is a market structure? There's a lot of smart money concepts. Everything talks about market structure. That's the most important thing. If you're not understanding market structure, that's when you will start relying on the ATR or fixed stops, and then you're going to pick your stops based on your trade entries. Okay, since there are a lot of market structure, I'm going to talk about one simple structure. I don't want to get into details today. So let's say that okay, let me go back one more second here. So one of the answers that I got was like last pivot points. Okay, so what pivot point means? Let's say if you are entering the trade here, if you are entering the trade somewhere, the stop what they are saying is some traders have answered they are using pivot points last swing. That means they are using this as the stop, last swing, last pivot point. They're using this as a stop loss. This is a good one, except that if you are taking that little far away, your risk is a little bit larger. But this is better than, much better than the fixed or any ATRs. Okay, so most likely I used pivot based stops for so many years. So don't get me wrong, that's definitely better than your fixed stop losses or ATR stop losses. But still, the swing points have some drawbacks. Let me explain. Let me explain in terms of how the swing and the pivot point stop losses have issues. Okay, so let's look at the market structure. In that case, let's understand. Let's take a look at this market structure. When the market goes like this, and then you wanted to, market is going down again. You wanted to take a trade. So this time you are going to take the trade here. You're going to take the trade here. So in this case, where do you guys think the stop goes based on your swing point, like your last pivot point? It's gonna go where? It's gonna go right here, right? So because you are looking at the last turn, and then you're going to put this stop loss right here. So if you understand the market structure, one of the solid market structure is supply and demand system. Supply and demand system is something you can use just based on the level 1 data, price action based. So what it does is it will give you the exact level where price is getting reversed. That means anytime the price goes up, I think sellers are stepping in, pushing it down, pushing it down. But when you enter the trade like this, if you're relying on this swing, last pivot back, you're putting the stop here. That is what will happen then. You need to understand, in that case, the price can still go again like this, go back to the supply level, come back here, go back here, because this is where a lot of sellers are ready to sell. That means price can still go. That's why you can see that these swing points will fail when it comes to the trading. I guess it me so far. Any questions? So doesn't matter. Swing point is good as long as the swing point is near the actual supply and demand. So if you look at some of our training webinars, we talked about supply and demand trading strategies. We talk about a lot in terms of how to use stops based on supply and demand. So what we recommend always is use the supply and demand. It doesn't matter using our indicator or any indicator. Use the supply and demand system. No matter how you enter, make sure your stops always above the supply level. So I didn't say stop goes here. Please note that point. Please don't always also recommend, don't put the stop right here, because most of the time there is a market structure concept called liquidity sweep. What it means is the prices can go back and then take the liquidity and then come back again. So that means you need to have some breathing room to have it. So again, we talked about fixed, we talked about ATR, we talked about the swing points. Now we are talking about the supply and demand based system, where you have to place your stops above, uh, find the supply, in this case short trade, find this supply zone, range of price, make sure you find the outer edge, and then place the stops above. Okay, so this is one of the better ways you can always do, but there are still more ways. Okay, stay tuned. Okay, so let's look at and then there's something called market maker strategies. um, because most of the time we focus on our trade in terms of our strategies, how we want to trade, how we want to exit, everything. If we do not focus on how the market makers manage the market every single day, because a lot of people have questions about, oh, they are market makers are after my stops, they are stop hunters. That's very true, but the point is they are not after your stop, they are after the liquidity. Okay, so if you don't understand the market, how market makers operate, what is the business structure or how trading structure of market makers, you're going to miss out few things. the problem is it's going to take you out. Let me give you some example. Okay, let's say the market is trending down. Market is trending down. All right. So if the market is trending down, in this case, the supply and demand is keep on shifting. Right. In this case, your supply is keep on shifting. The way it works, every time the swing point become your supplies, swing points. Okay. That means if you wanted to enter the trade, you have to have, let's say in this case, let's go back. If you are going to enter the trade in a trending down or trending up, both ways, but in this case, in this example, I'm talking about trending down. Let's say you wanted to, you see that market is going down, so you wanted to enter a trade right here. So obviously your stops can go here, and then if you are going to enter the trade anywhere somewhere here, the stops goes here. Okay, now the problem is market makers will take you out at some point. That's what market makers always keep on looking for liquidity, where they can take a lot of contract at small move. That's their goal. So think about in this case. Let me show you something. So in that case, let's say the market is moving in trending like this. So one of other ways you can, a lot of traders does is they use the trend line as your stop. That means you can have your stops here or stops here, stops here. Always try to keep a stop based on the way it moves. That's also one of the way. Okay, so at one point, even if it's the swing or the trend line, let's say you keep a stop. I want you to notice this particular price action. Look at this. Price moves. If the stop was here, what will happen right now to the price? The market makers takes the price, takes all the stops out, and then move the market, continue in the market direction. Okay. Again, look at the market trend. You'll see time and time again, every time there is a market trending up or trending down, this market manipulation always be there. Let me show you some charts as well. Okay, so, because this is why, even though you are entering the trade perfectly by these pivot points and then the trend lines and the shift of supply and demand, by all the rules we talked about so far, still sometimes you're going to be they are going to take you out, take your contracts, and then still moves on. Same thing right here. Okay, same thing right here. You enter the trade, you have the stops, you're going to move, they're going to take your stop and then move down. And then look at this. Even now, even the next one, you keep your stop right here because you have the big move. And then what's the market makers do? They try to, market makers goal is to always not to hunt your stop. Their goal is to always find the liquidity to make the market efficient. So that's why they need to go back and then take your stop and then go down. This is why in these cases your ATI is going to fail, your fixed is going to fail, your pivot point is going to fail, your supply and demand is going to fail. Okay, so out of all those, I'm trying to rank here. If you understand what I'm trying to say, supply and demand is the best so far. Second best is pivot points, and then everything else, ATR, and then the fixed stops. Okay, so that's why in terms of, you need to make sure which one to use, but there are a lot of more ways which we talk about in general now. So we can keep on trying to find the lines. Okay, so in that case, I wanted to introduce one more concept before I bring out the powerful way to use a stop loss is, if you are going to use even supply and demand or like swing points, one more thing that you can use in your stop loss strategy is figure out your failure point. Okay, I think this one I wanted to a little bit draw it out to show you. First, like I mentioned, understand the market structure, find the edges like pivot points, everything we talked about. When you say edges, it could be pivot points, it could be the supply and demand levels, and give some breathing room. Don't put right on the swing point, right on the top edge of the supply or demand level. Give some room, because always market makers is going to hunt the highest liquidity point, sweep the liquidity, and then go down. That's their job. That's the algorithm of all the high frequency traders. Okay, so always have some breathing room. So I'm going to talk about a little bit about this. Use a failing point as stop loss level. Okay, this is something I taught in a lot of videos and webinars, but um, here is the topic. Stop loss level is a perfect way to explain it. So let's say, again, let me give an example of supply and demand. Okay, so in that case, market is moves like this, right? Moves like this. Okay, let's say market is moving like this. In this case, market is going sideways. If you are a scalper, what are you going to do? You're going to find the supply and demand, right? So what are you going to do? You're going to draw the supply level. Okay, you're going to draw the supply level, and then you're going to draw the demand level. Okay, so either use indicator or drawing manually, doesn't matter. So in that case, if you're going to enter the trade, long trade, uh, right here, okay, long trade, because its market is going, you wanted to have the long trade here. Target, sorry, not the stop loss here. Stop loss, like I said, the demand, long trade demand level is here. Don't put the stop or right on the edge. You need to put it right below. So why this is the great way to enter is, I wanted to look at the rules that we talked about. Use the failure point as a stop loss level. When I say failure point, meaning if you put your stop loss here, let's say, okay, let me draw that in a different way. Okay, so let's say the price can come back down, still your trade theory is still valid, because that means you're expecting the price to come back and bounce and then go up, right? So still your trade theory is valid, right? So in that case, if you okay, let me actually, I removed it. Let me draw again. Okay, so in this case, again, the demand level, supply level. So what we are thinking is that even in that case, the price can come back to the demand level, can go up. That means as long as the price stays in this range, your strategy is still valid. Okay, but think about the moment price goes down, further down, is no more a long trade. Are you guys with me so far? As long as the price stays in here, you can enter on the bounce, you can enter the long trade. But moment the price goes down at certain point, that's what we call it a stop loss point. So the way we are calculating a stop point as failure point, what it means is that even the price come back, return here, still long, come back, this is long, even sometimes it goes below the supply demand level, still goes long, still this is a valid setup, because your failure point is right here. Moment the price goes down, crossing this level further, that means it's no more a long trade. I wanted to find the exact price level where below this point it's no more a long trade. I think we should exit the trade. That's what we call as failure point. That's what you issued as your stop loss level. Until what point you are still believe in your trade, or after below this, if the price moves below this level, my theory is no more valid, so I should exit. That is what we call as failure point. Use that every single time. So in this case, we talked about, let's go back to explain the same thing. Okay, so okay, you can apply the same concept to everything. In this case, when the price goes there, as long as the price, so even in this case, okay, let's talk about, we talked about the stop loss levels, right? This stop loss, this stop loss, this stop loss, this stop loss. Even in this case, even the price goes back and then come back down, you can see the liquidity swept happen. You can re-enter again, keep your stop here, because it's a liquidity sweep. Take the liquidity sweep, it's coming back down. That means that's a part of the market structure. That's part of the market behavior. You need to know how the market makers work. You need to know what is liquidity sweep. You need to understand those things. Still, you need to keep on top of them. Okay, so in that case, let's move on. Okay, we talked about those. All right, so this is where I put up some rules together. So make sure these are the points you always keep in mind. Number one, you need to make sure stop loss should go where the stop loss should go. What do I mean? You cannot pick your stop loss based on your pain threshold. It doesn't matter how much you want to lose, how much you can lose, or what is your account size, or what is your pain level, doesn't really care. Market doesn't really care. So you need to pick your stop loss based on what is the market structure, what is supply and demand levels, what is the, did it go through the liquidity sweeps already, all those things. Understand it, find the stop loss. That's why I say stop loss should go where the stop loss should go. It does, stop loss should not go anywhere because you entered a particular trade in different price. Okay, stop loss should not be determined based on your trade entry. Okay, and then here's most important point. I'm going to give you a reverse strategy. How many of you pick your stop loss? Uh, uh, sorry, how many of you trying to find the stop loss after you make the trade entry? Type yes or no, something, because I want to know how many of you even start thinking about the stop loss, where to place stop loss after taking the trade, after taking the trade, right? So I want you to reverse the strategy, reverse completely out. Let's say you wanted to take a trade, you want to take the trade. Don't think about the trade entry. I want you to think about the stop loss first. Okay, stop loss first, and then you can always find it. What do I mean by that? So number one, don't enter the trade anytime. Doesn't work that way. First, I want to select. Okay, so right now I can see the supply and demand forming, or trend forming, or like sweep happen, something. So whatever you see, I want to find where the stop loss should go first. Okay, where would be the, what will be the failure point of a trade? Find the stop loss first, and then enter the trade. Then enter the trade close to your stop loss level. We call that as towards an away strategy. So let me explain in a second. Okay, so let me explain what do I mean by that. But I want to read this one more time. Do not enter the trade anytime. Find where the stop loss should go first. Then enter enter the trade. Actually, I made it wrong. This poor English. It's okay. Sorry. Enter the trade close to your stop loss. Okay. Enter the trade very close to your stop loss. We call that as towards an away strategy. Let me explain you a little bit. Let's say this is the market. Okay. I'm going to show the supply and demand. First thing is you need to know what is the market structure. Is it like a market is consolidating going sideways? Then I can use supply and demand. If the market is trending down or trending up, I can use the trend lines and the pivot points. Or it's like sweeps happening, I can use a sweep as a point. Doesn't matter. Different. In this case, example, I'm going to show you based on the supply and demand. Moment you can see right now, after all these price action, you can tell the market is going up and down multiple times. You can clearly see this is the supply level, right? Because it's a rejection 1, 2, 3, 4, 5, 6. 6 times it is rejected, right? So that means it's clearly this is supply point. In this case, the way I am saying is, if moment by looking at this, you need to know this is where your stop loss goes, right? Don't think about entry yet. I want to determine where the stop loss should really go. Why? This is a failure point. If the prices crosses this level, goes past, it's no more a short rate from here. So that's a failure point. Now, since you know, you determined what is your stop loss level, now I want you to think about your trade entry. How to trade entry? Okay, now the price took already, came back down, it's going back again, it's going close to the stop loss. See, the stop loss is going close. This is called towards. That's what I meant by towards and away strategy. When I say towards and away, this is what I mean. Price is going towards your stop loss, towards the stop loss, but it's not crossing. It's taking a turn, start going away. This is what I say by towards and away. Price is going close to your stop loss, where you think stop loss should go, and the price is turning. When you're about to turn away, that's when I want you to enter. Okay, so what did we do here? Most important point is we determine what is the failure point. We enter the trade based on where the stop loss should go, and then uh, try to find the price action, go towards, turn, and then we are going to enter. What it does is it's going to help you minimize your risk. That means you will not enter the trade late here or here or here to have a huge stop loss risk. It's going to help you to enter as close as your stop loss level. Are you guys with me so far? the more closer your if you are able to enter your trade closer to your stop loss, then that's a best way you can minimize your risk. I'm reversing the way you trade. Usually you place your trade first and then pick your stop loss. The way I'm teaching you is pick your stop loss first, determine where the stop loss should go, be confident, have a confident level. Okay, this is where stop loss, I can see the price action, everything. And then I'm going to see if price is going to coming close to the stop, but I'm not in the trade yet, price close to the stop, and the price and then start turning. It's okay, it's already turning. Now I can enter the trade. Now my stop is where the stop should be. My trade entry is very close to the stop. Now, okay, so now who can tell me where the target goes? Okay, if you guys listening, uh, who can tell me uh, what the target goes? Again, the same thing. Think about the opposite of the stop loss to target. So in this case, I'm looking at, this is the demand, right? So our target really not here, it's somewhere here. Why? In the Fibonacci series, there is always a concept of price always can retrace back to at least 60% of the level. Sometimes even I put my targets somewhere here, at least. Same, remember that I put like a 6 ticks, 7 ticks away from the edge. Outer edge in the targets is inner edge. Okay, so again, use the same concept. By this way, you're able to perfect your stop loss, perfect your entry, perfect your target. This is how you can trade, guys. This is how you can trade, by not by random entry and then putting a fixed stops based on entry and then getting stopped out again and again, blow your account. Stop doing that. So this way you can take, the beauty about this strategy is that moment you are learning to take a trade with less risk, you can take more trades, you can fail more trades. That means you are losing small amounts than big in one trade. If you don't have the strategy in stop loss, you might lose all the profit you made in 3 trades in one single trade. That's it. That's why learning to use the stop loss first before a trade entry is going to help a lot. Okay, so all right, so let's move on. I got a lot to cover. Okay, so same thing here. Okay, even the same thing here, even even in the structure, in this case, supply is here. Don't put your stop here. You got to put your stop loss where we are talking about. Always your stop loss here, right? So that means where is it? Okay, so in this case, when the price goes towards it, since I know where the stops should go, right? Stop should go. Since a price is like going towards, I can take this trade. How about this one? Price is going, not closed, it's turning. This is where I want you to use your risk management. My pain threshold is only like 10 ticks. I don't want to lose more than 10 ticks, right? So what do? You look at this, the price is turning here. That means I look at this is 30 ticks. My pain threshold is like 15 ticks. You know what? I'm not going to take the trade. It's okay to not take the trade. But my point is, stop loss should go where the stop loss should go. Try to take the trade closer. If your threshold is like a pain threshold is only 15 ticks, 16 ticks, 20 ticks, if the price goes within the range of the 15 ticks, 20 ticks there, take it. If it's turning far away, don't take it. Don't take that risk. Don't take that risky trade and lose all the money in one single trade. Don't do that. Okay, so let's go back again. In the same thing, even in the same case, you need to know where your stop should go. And then when let's say in this case, we know that the stops should go here, right? Stop should go here, stop should go here, something like that. So that means when the price is coming back here, because the trend line, you see the trend line goes close to the trend line, start turning, you can take the trade right here. Put your stop loss right here. This is the way you can trade. Doesn't matter, right? So it goes every single way. Doesn't matter what kind of market structure you are in. Understand the market structure, understand the exact way where the stop loss should go, and then try to find the trade entry. Okay, and then try to find the entry. So let me repeat it. If you guys are with me, do not enter the trade anytime. Don't do that. Find where the stop loss should go first. then enter your trade very close to a stop loss within your pain threshold. That means price should go towards your stop loss and then start turning and starts going away from your stop loss. Then that time you can enter, okay, towards and away. Don't forget that. Okay, so all the things what I thought so far for everybody is trading right now. What are the strategy you are? But I'm going to teach you something. If you have liquidity zones, if you have a level 2 order flow, if you know how to look at the order flow, you look at the level 2 data, that's going to change. That's going to even improve even way further. You can dial it way up. So the best way to perfect a stop loss is find where other traders have been placing the stops. You can find in level 2, you can find it. You can find where majority are placing the stops. Okay, and then I want you to hide your stop behind their stop. I'll explain in a minute. Okay, and then you need to understand some of the best trades happened after the masses got stopped out. This is something I did not understand what they're talking about when I started years back at the time, but more and more you understand how the order flow works, level 2 works, you will see, oh my God, it's happening again and again and again. A lot of people stopped out and then the price moves. I want you to remember this line. Some of the best trades happened after the masses got stopped. I want you to remember this line because I'm going to show you in the chart from this week, at least twice this week. Okay, let me show you as well. So again, the how to find where other traders have placed their stops. Okay, the only place you can find that is in the level 2 data, because every time when you place a stops, when you place a targets, all those are limit orders. Those limit orders are visible to every other traders. It goes to exchange, and then with level 2 you are able to see all the information back onto your screen, right? So this is, let's say this is the this is from this week. Actually, this is from this week ES market. Okay, this is within any indicator. Now I have added the BSG liquidity zones indicator. What it does is it takes the level 2 order flow data, interpret, find the strongest order flow and plots on the chart. Okay, in this case, let's look at in terms of where how the market is like moving so far. So you can see the market is moving this way, and then you can really see in terms of where the supply. This is like a price action based. If you are using the price action, supply and demand goes like here, right? Okay, go here. But I want you to notice one thing here. Look at the stops. Look at the stops where it is not very close. Look at this. Stops is not very close here. Stops is a little bit far away. Even though market is like a fluctuating back and forth, the majority of the traders are placing the stops much higher level. Okay, and then that's why I want you to understand that level after supply and demand level. Look, I want you to check out this one. Okay, so let me mark it down. Look at this level. Look at this level. For this supply and demand, this is where the strongest lot of stops as per the level 2 data. Once this price crossed, look at where the support liquidity sweep. Remember we just talked about in terms of best trade happens when the majority got stopped out. Look at this. Market is going in a trending up. That means in the trending up, the market came back down, take the sweep, take out. If you watch this, they took out all these stops and then they move further along. Okay, so you can ask me, what about this move? I missed this move. Look at this. Look at this. Look at this. They took the stops right here. Masses got stopped out, right? This is where all these traders got stopped at. That's why use the strategy that taught you, supply and demand levels. If the way I taught you so far, based on supply and demand, your stop should go somewhere here, right? Somewhere here and then somewhere here. But look at where the stops were. Look at the sweep. This is why it doesn't matter what kind of strategy you are trading. It doesn't matter. You need to look at the level 2 data and then look at where the other traders are stops, the placing concentrated. Then you'll be able to see the price can go until this point. Okay, that's why even in every single case, you can see how the price moves after the breakout. We teach this particular strategy as the one strategy you can trade in level 2 data. That means you'll find the strongest liquidity in the data, breaks out, retest at the same level, exact same level. Okay, and then goes back. In this case, it's a perfect because it took the liquid sweeps as well. It swept the liquidity and went up. Okay, are you guys with me so far? Any questions? Anything? Let me know if you have any questions before I move on. Okay, so I think so far I don't think anything should stop there. Let me move on. Okay, so in that case, let me also show you one more chart where I can show you the other concept that I try to explain. This is again from this week. This is the same thing. BSG liquidity zones on the same chart level data. So remember that we talked about in terms of remember the diagram that I showed you when the market is trending. It sweeps liquidity out and then go down, sweep the liquidity out. Do you remember this particular thing we talked about? When we place the trade, eventually they will take, the market makers will take your liquidity and then go down. This one, I'm going to show you in a live example. Okay, so let me show you in the live example right here. When the market opened, you can see the market was like consolidating here, and because there is a strong liquidity outer edge, it broke down, market went up and then gone down. This is where the majority people have stops. It went down again. Okay, but I want you to watch a couple of things here. Okay, look at, there are liquidity here, the liquidity here. They take the liquidity. Okay, and then if you are a supply and demand trader, you will see this is where supply, right? This is where you have the supply. This is where you draw the supply in this range. Look at what happened right there. Okay, look at this liquidity sweep. Okay, but look at what happened. Price went back, take the liquidity. This is the largest liquidity. This is the largest liquidity. Okay, supply and demand level, but stops is not here. Way up, the prices went back, took all the liquidity and then go down. Okay, this is where you can see every time. I wanted to think a little bit differently. Every time there's a huge push, there will be a liquidity sweeps. That's why I wanted to use. That's where I wanted to use liquidity zones. Look at the strongest level, and then hide your stop behind it. Let me give you an analogy on hiding your stop. Okay, so I talk about that a lot in the other webinars. If you are going for a war, let's say you are a soldier, you're going for a war. If you are the first person on the war front, okay, if the enemies are coming in, if you in the war, if you are standing in the front line, you're gonna get killed. You're gonna killed really terribly, get killed. But what if you are standing way behind thousands of soldiers, and then like the only way they can kill you is getting past all the soldiers right in front of you, right? So I want to think about the same way. If you are keeping your stop loss behind the strongest liquidity, that means this is like hiding your stop behind these soldiers. If at all price is need to take you out, it need to take out all these soldiers and then only can get to you. But if you keep your stops right here, think about it. If you keep it, because you can see, oh, the pivot point, I'm going to keep my stop right here. What do you think is going to happen? You're going to get killed. That's why, even though the pivot points are here, I want you to look at what is the strongest liquidity. What is this? Once that is there, you can see new liquidity coming up. You will start analyzing again and again. Then you realize how the market works. Even sometimes pivot point doesn't work. Only order flow based liquidity stop loss is the much better way to protect your trade and protect your capital. So again, in this case, Since I see this is where all the liquidity are, now I determine this is where my stop should go. Okay, this is where my stop should go, and then I'll wait till the price come back close towards start turning. You can take the trade. You can take this trade. This is how we can take the trade much efficient way. Always use level 2 data to find where majority masses of the other traders keeping the stops. Okay, so um, to let's move on. Again, you got to look at level 2 data. That's why we have BSG liquidity zones indicator designed. Actually, we designed it for the trade entries because we love the breakouts on this trade. The highest probability trade you can find anywhere is the breakouts on those levels. Okay, even in this simple example, right? So if you look at the simple example right here, market is, what is it? Market is consolidating. Here is a supply, is a sell side liquidity, like buyer's control. When it's broken and then came back, moment you can see all the liquidity right here, I will know the stop should go here. Price is coming back here, start turning. After liquidity has all gone, I'm in a very good trade. This is will happen again and again. Okay, so that's why I say not only liquidity zones are great for entries, it's also great for your stop loss levels. So that means doesn't matter what kind of strategy you use, what kind of trade entry you use, still you need to use level 2 insights to determine your stops. Okay, this way you can protect against market manipulations. You can protect against in terms of just not swing points, not a supply and demand, anything. You can purely based on order flow. So apart from the stop loss strategies in order flow um, uh, liquidity streams, we also have like setup one where we teach about consolidation, breakout, retest, swap. At the same time, other strategies also, consolidation, came back, retest, same thing. I'm not going to talk about these things much. There are other videos on the YouTube channel. You can learn about these strategies in there. Okay, but let me show you the same thing this week, how we are able to take not only the trade entries, also the stop loss levels. Okay, so you can see right now, we can see the market was strongest sell orders, strongest buy orders right here. Once it was broken, once we saw that lot of, okay, let me go back. Once we saw, you see the red lines, I'll keep writing about that. Okay, once you see the red lines, we can see the sellers are coming in now. This is what we called as a setup 1 and 2, breakout and retest the same place. We took the trade, we had our stop right here, but when the price moved, we keep trailing the stop. Right now I have my stop, look where, behind this red liquidity. I'm trying to hide my liquidity always. That means initial stop was here, and then market moved, and then moved my stop here because there's liquidity. A lot of people have stops here. Market moved, and then there's a swing point. A lot of traders moved the stop here. Now I move my stop behind them. Always I try to continuously hide my stop behind the other people's liquidity. Okay, that's why not only initial liquidity zones help you with initial stop, initial trade entry. Continuously you can manage your trade on trending market or in a chart market as well. Always try to hide your moment you see one more strong red line, so a lot of sell orders, you move your stop from here to here. Always continuously hide your stop. Okay, all right, so this is another trade, the same thing, same concept we talked about. You can see the consolidation, breakout, retest, lot of stops. I kept my stop here and then keep trading. This is both the trades are like both, each one just one contract. Other one was almost 1500. This is, I closed at almost like 1900 on this trade, one contract, because we purely rely on level 2 data, not only for trade entry, also to find the perfect stop, also to trail the stop for multiple purposes. Okay, so you can find out in terms of other traders how they are using our product, doesn't matter. I think most important point is you need to get the access, you need to start practicing it again and again and again to find the market behavior, repeatable behavior, how the market is behaving, liquidity sweeps. stops hunting. Everything I wanted to expect it. I wanted to expect it. I wanted to plan for those things. So the way I see it, to liquidity zones is to first thing is to find high probability trade entries with level 2 data, and also perfect your stop loss levels for every trade. Also use our towards and away strategy to enter trades with minimum risk. Okay, minimal risk, that's very important. Okay, so actually I wanted to